Good day, everybody. Well, welcome back to the Corellian Academy. There's an awful lot going on in the economies around the world. Traders and investors trying to get a handle on what's going on. Tonight, I want to focus on the UK economy, which, to be honest, is feeling quite a little bit of pain out there. I think the UK economy is back in the spotlight. We're still trying to get over Brexit. We've lost a lot of foreign workers. We've got rising wages. Last Monday's GDP number was surprisingly low, slightly backward looking, but not good news. So things could have got even worse since then. So we need to sort of look at this. It was the sharpest decline in a year, raising the fears that the economy will actually start to contract in Q2. So have we got recession coming? It's a good question. Well, still, it was the first time since January 2021 that all three sectors of the economy fell at the same time. This is not good news. You would expect either manufacturing, so consumers buying goods, would have held up. If not, then they moved to services. That should have held up. We've seen them all fall. And these are not good indicators for the health of the economy going forward. So we need to bear this in mind as a sort of base scenario as we move forward. So the UK government and the Bank of England, is now going to have to look forward from that data and try and figure out what to do with interest rates. Now, do they hike because of inflation, or do they hold because of weak growth? The thing that worries me a lot here is that UK consumer sentiment has literally collapsed, and we're down at 50-year lows. We haven't seen the psyche of the consumer being hit quite so hard. And this is bringing cutbacks. Consumer gloom here, you can see on the chart on the right, more pessimistic than at any time in the last half a century. This is not good news at all, because this can spill into weak retail sales, which in fact we have seen in recent times. That data getting worse by the month. But also we've still got a few issues with this Brexit feud with the EU, and there's still outgoing issues going on here. We've got a UK trade deficit for goods and services. It's widening. This is not good news either. We're importing a lot more than we export. A weaker sterling not really doing a great deal to help either for some reason. But I think the global investors are losing a bit of faith in the UK, and I'm not surprised. We have a pretty shaky government. And we have a central bank that it seems to be sort of caught in the headlights, as it were, when forecasting 11% inflation and raising rates 25 basis points is just a nonsense. So UK households are feeling the pain. I think in every walk of life, to be honest, we've only seen a small rise in unemployment. And that's actually whilst there's record job vacancies. So there's an awful lot of jobs in the UK that British people simply do not want to do. But the problem with rising wages is it's not rising quick enough to actually keep up with inflation. So real pay growth, if you like, real wages are actually falling, and therefore less money is available for non-essential spending. And that means a potential contraction in economic growth, with the consumer in the UK being 70% of GDP, or growth, if you like. So that's really important to spend some time thinking about. The spending power of the UK household has fallen the most in 20 years because of this. So they literally are spending everything on essentials. And that means that living standards are falling. Now, this feeds into a lack of or poor sentiment. They're less confident than they were. Everybody's reassessing the sort of things they want to buy. Are they going to buy big ticket items? Probably not. They're much more conscious about how much they're spending on food and energy. Are they going from a more expensive supermarket to a much cheaper one? I think there's a lot of that going on. So now this, essential percentage of this essential budget is much larger than it was, and about to get higher when energy prices go up yet again in the autumn, and that's going to hurt as well. So more to come on that side of things. So, what does the Bank of England do? Well, we saw the Bank of England last Thursday. They came out and said, oh, yeah, we see inflation at 11%. And what do they go and do? Raise rates 25 basis points. Goodness me. That is just throwing a pea shooter at a herd of charging rhinos, basically. And it just isn't going to do the job. It just does not cut it. 3 out of 9 voted for 50 basis points quite sensibly. But it seems the Bank of England is still worried about growth. But they're going to have weak growth if they don't get inflation under wraps. So, this this soaring inflation needs to get put back in the bottle. And the only way of doing that is by raising rates more aggressively. Now, the market is beginning to price that in. So although the Bank of England has been very tentative in its moves, the market is pricing in almost 3% rates by the end of the year. Now, that's quite a steep climb, which means 50 basis points at every meeting. And already we're seeing 55 basis points priced in for August. So the market is raising rates for them. Will the Bank of England match that and do 50 or even more possibly at the next meeting? Because looking at inflation, it's not coming off. And if you look at the RPI, which is the retail price index, I think it was 11.7% today, another high. PPI, which is finished good factory gate inflation, another high. This inflation is everywhere. It's not just in CPI, it's everywhere. And I do worry that the central bank is allowing this to run away with it. It should have done 50 at the last meeting. I would have thought that would have taken sterling down. But what we did see is that the UK gilt market, as you can see here on the right, yields rallied strongly last week, and that took sterling up. So you can see that high post-BOE decision on sterling there in the pink channel, up to 124.06. We hovered around there, and then, and the market lost faith with sterling a little bit on that. We have seen a rally today, but that is very much a broad dollar sell-off, not sterling strength. So we've seen BOE's top economist, Hugh Pill, say that bank is prepared for aggressive rate hikes. But, well, why didn't they hike last time if he's saying that 3 or 4 days after the last meeting and they forecast 11%? Not good enough. And this tentative stance is usually a signal to markets to punish currencies or central banks for that. And we did see a bit of that. We got down to 121.60, I think, this morning. But the broad dollar sell-off, which seemed to be on the back of a real concern over global demand for everything because commodities fell hard, took the dollar down and lifted all boats, including sterling. But sterling, against many others, is still looking rather weak. If we look forward, Pill said that he would sacrifice growth to cut inflation. Well, why didn't they raise 50 basis points then? I still don't get that. So, what they say and what they do seem to be different things at the moment, which is disappointing. We saw 9.1 expected on the CPI print this morning. It's extraordinarily high. This is a 40-year high. Core CPI increased. It was expected at 6%, but 5.9% is still high. This is not peak inflation. This is still way above expectations. And, even if we do see peak inflation, can they get it back to 2%? I don't see that for some time. So the chances of a 50 basis point rate hike are definitely rising. And to be honest, in the bond markets, at least, are priced now. So it looks like we could get 50. Will the Bank of England disappoint? If they do, sterling is going straight down hard. So I think we need to be careful of what sterling does into the next meeting, but that is some way away. But in the meantime, we've got an awful lot of, issues, questions, so many questions about the British economy at the moment. And to me, it doesn't look great. We've got a survey just recently showing respondents decidedly downbeat about UK assets. I think the FTSE had done very well because of its makeup with commodities, energy, oil, mining. All the commodities got hit hard today. So the FTSE looks like it could be quite perilous and could catch up to some of the others. So there's some real disappointment now in UK assets all the way into the FTSE 100 as well. So are traders getting too bearish on the UK and sterling? I don't think so, but we have had a good rally in sterling because that is against the dollar. Maybe it's time to start trading sterling against something else. But you need to find something that you believe can rally against it. And at the moment, it certainly isn't the yen by the looks of it, but there's a few other options out there. But again, we've even seen, because of the commodity sell-off, we've seen the Aussie lower. We have seen a rally in the euro. But again, all of this is dollar-based today. So I think we need to be very careful. Sterling looks particularly vulnerable because the economy, I think, in the UK is one of the weaker ones out there. And the danger of a phase of stagflation seems to be rising. And I think we need to be very careful about that. It's going to be a tough time with tough decisions for the Bank of England going forwards. So that's about it for me. I'm going to sort of call that a day there and hopefully back for some questions some other time.